Warren Buffett spends about $1.3 billion on Coca-Cola stock back in the late 80s. And he never buys another share. Today, that same position pays Berkshire more than $800 million a year in dividends alone. That's a yield on cost north of 60% every year, without lifting a finger. Here's the thing: Buffett didn't get lucky. He followed a repeatable process. And in the next few minutes, I'll walk you through that exact process, step by step. I've spent 50 years watching investors chase hot stocks and lose. The quiet ones? They built dividend machines. And the fourth step is the one almost everyone skips. Let's start with why this works at all. A dividend is just a slice of profit the company hands back to you. But a growing dividend? That's a company telling you, every year, that it's healthier than the year before. And the data backs it up. Ned Davis Research studied stocks from 1973 to 2023. Companies that grew their dividends returned about 10.2% a year. Companies that paid nothing? Just under 4%. That's not a small gap. That's the difference between retiring comfortable and retiring worried. So the goal isn't high yield today. It's rising income forever. Remember that, because it changes everything about what you buy next. Now, where do you find these companies? You start with two lists. The Dividend Aristocrats, companies in the S&P 500 that have raised their payout for at least 25 straight years. And the Dividend Kings, the elite few who've done it for 50 years or more. Think about what that means. Procter & Gamble has raised its dividend for 68 consecutive years. Through the 1973 oil crisis. Through Black Monday in '87. Through 2008. Through COVID. Coca-Cola? 62 years. Johnson & Johnson? Also over 60. These aren't guesses. These are businesses that survived every disaster the market could throw at them and kept paying you more. But a great company at the wrong price is still a bad investment. Which brings us to the part that trips people up. Here's where discipline separates winners from dreamers. Two numbers matter most. First, the payout ratio. That's the percentage of profit going to dividends. Under 60% for most companies means the dividend is safe and has room to grow. Push toward 90 or 100% and you're one bad year away from a cut. Second, the price. A wonderful company bought too expensive gives you a tiny yield and slow growth. This is Benjamin Graham's margin of safety. Buffett bought Coca-Cola when the market panicked after the '87 crash. Cheap, patient, deliberate. As Graham put it, price is what you pay. Value is what you get. So you screen for quality, then you wait for the price. And when you finally buy, you do the one thing that turns a good portfolio into a fortune. This is the step almost everyone skips. When your dividends land, you reinvest them automatically. Every dollar buys more shares, which pay more dividends, which buy more shares. Let me show you the power. Since 1960, if you'd invested in the S&P 500 and spent your dividends, you'd have solid returns. But if you'd reinvested them? Studies show reinvested dividends account for roughly a third or more of the market's total long-term return. This is compounding doing the heavy lifting. Slow, steady, and quietly. Unstoppable. And none of this is a recommendation to buy any specific stock, it's a framework. Always do your own research. Past performance never guarantees The future. So here's the whole thing in one line. A dividend growth portfolio isn't about getting rich fast. It's about getting paid more every year for the rest of your life. Buy quality. Wait for a fair price. Reinvest relentlessly. Then let time do what it does best. So let me ask you, what's one dividend stock you'd hold for 20 years? Without blinking? Tell me in the comments. I read every one. And if this changed how you think about building wealth, hit subscribe. We do this every single day. Tomorrow, we're breaking down the one behavioral mistake that quietly destroys more portfolios than any crash ever has.